Welcome to MGAA Conversations, a new podcast channel where we'll be discussing with an exciting number of guests all things related and topical within the ever-growing MGA community. Welcome to the latest edition of MGAA Conversations. Today, I'm absolutely delighted to welcome Rachel Turk, Chief of Market Performance at Lloyd's of London. Rachel, a very good morning to you.
Good morning. Thank you for having me. Great.
Okay, so let's get straight to it. So Rachel, sort of Chief of Market Performance, perhaps for our listeners, you could sort of explain a little bit what that role takes in terms of what you do and the rest of your team?
Yeah, absolutely, because it's one of these lovely made-up job titles that we have at Lloyd's. So effectively, I'm responsible for all of the market performance. So the outward-facing teams that look after performance, that's the underwriting teams, exposure management, outwards reinsurance, claims, and all of delegated authority. So we're really looking at maintaining performance of the market, helping protect the balance sheet strength and the capital rating as a result of that through targeted oversight and constant communication and liaison with the market.
Okay, so that's basically all across the world in terms of where Lloyd's sort of where business is undertaken.
Yeah, pretty much. I mean, obviously, our main focus is on the managing agents, and so we're obviously based in London, but worldwide, from a premium perspective, 60% of premium at Lloyd's comes from North America. So we definitely have a global perspective on insurance markets overall. And then, we spend a lot of time talking to the managing agents in London, but also, Lloyd's is 3% of global P&C insurance. Yet we have an outsized voice despite our market share. And so we spend a lot of time talking to other, maybe sometimes non-Lloyd's players to find out what's also going on in the broader insurance market, because we play within the broader insurance market. So we can't be completely insular and just thinking it's only all about Lloyd's.
Yeah, that's a very positive sort of message, I think, to our listeners, and the fact that you're not in your little bubble. You sort of you recognise, see what's going on from there. So sort of bringing it a little bit round to the MGAA, in particular, my members. So if I'm right, I think 39% of Lloyd's business is in that delegated sort of cover holder space. I think with a view to grow. Okay, and we'll touch on market conditions in a minute, no doubt, from that perspective. We've done some surveys most recently, last sort of 2 to 4 years, with partnership with Clyde & Co. And each time there's a question to cover holder MGAs, if you had a choice between the company market and Lloyd's, where would your bias towards? And positively, if I go back 4 years, Lloyd's was probably not quite at the races. But since we did this survey in 2025, then that gap has narrowed. So Lloyd's actually has become sort of a more attractive market. So I'd be really interested in sort of your own view in terms of, one, in terms of the evolution and direction of travel of DA business in Lloyd's. And secondly, in terms of what do you feel Lloyd's is doing or can do more of in terms of make it more attractive to MGA's cover holders compared to the company market?
Yeah, well, I mean, firstly, it's great to know that we're narrowing the gap. So it suggests that some of the things that we're doing is helping. And, some of that is, doubling down on some of the structural advantages that Lloyd's has. I mean, we have an unrivaled license network, but we've obviously central settlement, the assurance that you get from some of the oversight that we do, and the capacity backed by Lloyd's and the central fund, etc. So I think being able to double down on that and really demonstrate the value that Lloyd's brings is really helpful. But then that's always been true. The big things is the efficiency piece. So, where have the efficiency gaps been compared with the company market? Where is it that Lloyd's centrally then can unblock some of those? So some of those, the evergreen binders, the continuous contracts, that's been quite significant. They didn't used to be permitted at Lloyd's. They were common in the company market. They're now okay. The improving the efficiency of the cover holder onboarding process. So we've been trying to do tactical changes. We've obviously got the decom system. We've managed to reduce 30% of the fields that needed to be put in decom. So just trying to make it all, where are the tactical fixes that we can put in whilst we might have a longer term strategy for overall efficiency. And we do also a lot of work. There's the streamlined compliance that's going on. And so all of those are just, I think sometimes, you have to just take a bit of a step back, take a little bit of an introspective look at what are the things that Lloyd's maybe has rules in place or barriers, etc., that are not helpful. Sometimes you chart back and go, why were they in place in the first time? And when the answer that I'm getting is, oh, we've always done it that way. Not the
Yeah.
greatest answer in the world. So we just go through a process of going, okay, well, like, does that have to be true anymore, or what has to be true for this to be the case? So try to make it as efficient as possible, because ultimately the thesis is that, why are cover holders such a valuable part of the Lloyd's market? It's really, people use them when they because they have unrivaled access to business. So they have a niche specialism that the managing agent doesn't have, or they have access to distribution that the managing agent doesn't have, and that will remain true. And when you think of the protection gap and or the underinsurance gap, there's an awful lot of risks that aren't being insured. And when you think that actually the cover holders, the MGAs, tend to be the first ones into some of the more niche areas, you can only see that this area will continue to grow. And we at Lloyd's want to capture as much of that as we can. So we need to get out of the way and make it as efficient as possible. So I think there's more to come on that, but I definitely see this as a growing area for Lloyd's.
Could I ask you, just if I pivot a little bit, come back on your commentary there, when as an association we have over 70 sort of capital providers actually, so it's obviously echoes and underlines your point around capital wanting to partner with sort of MGA stroke cover holders. And when I speak to a lot of those sort of 70, they replay back to me that they think the underwriting expertise, technical oversight, understanding, risk management is probably the highest they've ever seen it in terms of that MGA space. Would you echo that in terms of, I know some of that would be a transition from organisations into MGAs, but would you, in your experience, would you see now that the maturity and underwriting expertise in that sector now is probably as best as it's ever been?
Yeah, I think that's a really fair point. I mean, if we chart the evolution of MGAs over the past, 20 years or so, I mean, there are now many more, I would call them mega MGAs, right? Massive, massive. I mean, they're bigger than some of the insurance companies. They just don't have the balance sheet with them, right? So you've moved away from it being predominantly, quote unquote, mom and pop kind of, one-man band style MGAs to actually some really sophisticated organizations. And so there's a smattering, there's still some of the small ones, but there's an awful lot of sophisticated. So I think that's where the underwriting has definitely kept a pace with that. And I think there's been a necessity to do that as well. The requirements for the managing agents, the bar that's set for them in terms of their own performance requirements, they can't afford to delegate authority to somebody whose underwriting isn't up to scratch. And so you've got yes, I've definitely seen a huge improvement. And I agree. I think it's at the highest quality it has ever been.
Okay, that's a great endorsement. That's fantastic. Thank you. Moving across into market conditions. So I noticed, you flagged out a recent sort of Lloyd's quarterly market message that, the market was in a good place. I think you were quoted, but rates were softening quicker than expected. Could you share sort of your cycle expectations? Will it be shallow? Will it be will it be deep? Hopefully not. Any particular product lines you feel outward looking, maybe a bit more insulated? And also, I'd like to ask you about your. You talked at the start about these new titles around sort of portfolio solution teams, which I'm not saying it's necessarily that new, but certainly it seems to be the latest buzzword. So apologies, a lot to unpack in that question, but I'll hand it over to you if I may.
Yeah. So if I start with the market, so I think we're in a softening market, definitely not a soft market yet. And I've used words before of saying it's sort of brittle or fragile. And by that, I mean, I think it could go either way. So yes, we're seeing rates declining. Not universally, casualty classes are still having some rate strengthening. But, and obviously we've had a very light North Atlantic hurricane season, which will impact property rates. But yes, we're coming off some years of some decent margin, but not as much as you would anticipate. So if I chart back overall performance at Lloyd's using GAAP results, there's about, at a whole account level, about 6 points of margin left until you get to our sort of baseline of 95% right across the cycle. And it doesn't take a great deal. It doesn't take a lot of rate reduction a bit of maybe claims inflation, etc., to eat up that margin. Which is why I look at it and go, it's not like we're sitting there going, oh, we've been sitting on super profits for 10, 15 years. I mean, this has been like 3 or 4 years of the industry starting to make money after years of probably, suboptimal returns. If you look at it on a return on capital basis, the long-term return on capital is still not as good as it needs to be. So with all of those, I look at it, those external market dynamics suggest that we really shouldn't have a particularly deep soft market, because there isn't the margin in there for that level of margin contraction for a sustained period of time. I'm seeing individual product lines are obviously operating at different speeds. And so no one cycle is universal. I think casualty, as I mentioned, that one's still seeing a little bit of positive rate. I don't think it's anywhere near enough when you look at this sort of amount of social inflation. That needs a bit more. So that one's still probably got a bit more hardening to do until it gets there. I think cyber's one that I have on watch right now. I think it's a massive opportunity for the market, global insurance market. I mean, this under penetration of buyers is just incredible, but we don't seem to be converting new buyers. We seem to just be keep selling to the same buyers with more capacity coming in. So that's really unhelpful. So that's driving that cycle a bit. And property, as I said, I mean, kind of at the moment, we'll see what happens at 1/1 with some of the big renewals. But we're expecting sort of softening there. But again, it's coming. But property is coming back from a level where there's still a lot of margin in the account. So is it going to be? Is it how long is the cycle going to be? Don't know. Cycles, I think, are contracting. I think overall, our view is, so we use a couple of tools like a clock that we have of like how quickly what happens at every stage of a market cycle. Our view now is that you'll move round that cycle more quickly than we ever have done in the past. So and so the cycle will follow all the same dynamics to lesser and greater degrees in various different classes, but we'll just probably move around it. So previously, we've looked back in history, cycles were sort of 15 to 20 years. I think they're more like 8 to 10 now, right? I just think we sort of go through them much more quickly. So that's overall where we think things are. But I still think 2026 is going to be is a pretty good underwriting trading year, should be, all things being equal. Your second question on portfolio solutions, it is the new buzzword, without a doubt. And really, when we're seeing plenty of these divisions starting to spring up at insurers of them wanting to write really big cross-class facilities or backing, sometimes they're backing MGAs. We're looking at those and going that it is different way of underwriting from a traditional binder book of business, and very different from an open market underwriting. So when you look at the way those teams are constructed, there's much more in the way of data, actuarial, reserving, etc. And the underwriting actually is like 1 or 2 people from like a sort of a marketing point of view, rather than like the true underwriting that you would normally be expecting. It is much more, it's, as I said, the different skill sets. And we see those being very valuable, because when you're looking at bringing in big books of business, quite diversified chunks of business from a broker facility, etc., you need to be able to understand how that's going to interact with your open market portfolio or everything else that you're underwriting, how that's going to, your aggregations with how much peak peril, windstorms you might have, etc. So your requirement for the data and actuarial is actually bigger than it is on some of the binders, which you actually, there's still, yes, you're delegating your authority, but you still often get risk by risk bordereaux coming in as opposed to big chunks. So I do think it's a different way of underwriting. And I mean, this whole portfolio solutions, or the idea of these big broker facilities, quite a polarizing topic in the insurance market. I've been reasonably public at saying my view is that it's a structural change in the market, not a cyclical trend. These are here to stay, and they'll get done. Well, at the moment, they're nearly all done in Lloyd's, and we would like for that to remain. Therefore, we're very supportive of the portfolio solutions capabilities evolving such that we can continue to support this business profitably.
Do you subscribe to the market view, and this is market mood, that it's a way of insulating perhaps the softening market and reduction in earnings if you're sort of gathering up and consolidating into facilities, call it a portfolio, and therefore you can perhaps sort of protect earnings a little bit more in a weakening market? Or is that tittle tattle in the Leadenhall market?
Yeah, Well, because I'll hear the opposing view, which is
Sure, I know.
portfolio solutions are the cause of the soft market and they're what's driving rates down. So, or are they actually, if you put it all together, one of the challenges that we have is I think these portfolio solutions teams, of which there are a small number of them, and for them to work, they need to, because they're paying slightly more in acquisition costs, so they need to have a lower admin expense to do that. Therefore, they need enough scale to be able to offset the admin, right? So they need to be at scale. So there's a smaller number of people that are likely to be able to get to that scale that's required and the investment that's required in order to realize your admin savings. And therefore, some of this business that used to be placed in the open market on a follow basis is going to be taken away from that marketplace and put into facilities. So I think there's a huge competitive tension going on there at the moment from people that can see some of their traditional follow market business starting to be taken away from them.
Yeah, no, I don't disagree at all. And just before I move on to our next theme, if I could circle back around claims and claims inflation, do you think, the sector is attuned enough to the nuances around claims inflation? Because I worry at times that, that you can do all the best underwriting in the world, but if you haven't got the focus in terms of where claims inflation is, in terms of its direction of travel and how it can impact your underwriting result and your reserving, and in terms of the actions you take. And I just sometimes wonder how much focus is actually spent, not just in Lloyd's, but across all the market really, around claims inflation. I'd be interested in your view on that.
Yeah, I think it's a really great point. And one of the reasons actually at Lloyd's that the claims team moved to then come in to report to me into market performance is because claims is the other side of the coin. You can do the best underwriting in the world, but if you're not really paying attention on the claims side, whether that's from claims leakage from huge use of third parties without managing them, not actually closing your claims files quickly enough, so you've got an awful lot of expense going on, or not keeping abreast of inflation or claims trends, which then go straight back into your pricing model and your underwriting. Like that, you need that loop going on. So we moved the claims team to sit under my world so that we had a better lens on that one. I think there's way more that the market can do. And I've talked about this before with the market and said, if my 6 points of margin, sort of, rough maths that I was talking about, claims is the only area that can add back margin. Right, everything else, all we're trying to do is sort of slow down the margin erosion, but claims has an ability to add it back by either, managing claims inflation, managing defense costs, managing third-party leakage, etc. And I think there's a huge amount of focus more that's needed on that. Claims becomes a hurdle principle at Lloyd's under our principles-based oversight from the 1st of January, which is to try and elevate the standing of claims within Lloyd's and to elevate the importance upon which Lloyd's places on it. I still think there's way more that we should be doing as an industry generally and in Lloyd's particularly on the claims side. Fundamentally, as much as I was an underwriter for many years, I would like to have said obviously we're the most important people going, but the reality is you've sold a promise to pay. It's the claims team that's actually the most important team in the organisation, but they often don't get viewed that way. The underwriters get viewed as the ones that are the most important. So we need to shift that such that it's claims front and centre, because that's what the client's buying.
Well, that's a really interesting point, and I've tried to, and I'll admit this now. I've tried to change my language around when I talk about the claims community, because I think the typical phrase that it's back office is all wrong, actually. And I've been guilty. I've been in the industry over 40 years, far guilty of, and I'll say it affectionately, but when I used to say it was back office, when actually I think it needs a completely different appropriate label in terms of how important they are, that claims area. And it just has the wrong connotations when the word back office. So I've tried to sort of erase that. I can't erase history, but I've tried to erase it from any time I talk to any journalists or if I'm on stage presenting. So great. But I think really some really, really important messages around that claims piece. And, we do a claims conference every year with an organisation, I Love Claims. And we had one about sort of 2 months ago, and that was really at the heart of that the industry needs to be so much more around claims, and don't use the word back office at all. Bring it forward as just important. So it's really, really encouraging that you're seeing and echoing that same message. So pivoting to regulation, Probably sort of, especially in the UK, because I can't quite sort of work way out the US in terms of from state to state. So just a headline really question really. Are you? I know you're doing your own streamlined sort of compliance and the onboarding, which you've touched on. But when you look at the regulatory direction of travel, are you confident that they're doing things to sort of help and assist the industry? Are they moving fast enough? What's your current sort of takeaway?
Yeah, so I mean, I'm pretty optimistic actually in the UK at the moment. We've, the joint PRA and Lloyd's cooperation that we've sort of been talking about recently is a major move forwards. The aim to deduplicate the regulation that managing agents have between Lloyd's and the PRA is a massive step. And some of the things, the tangible pieces where that comes out is managing agent approvals. We've been running the pilot such that Lloyd's does the approvals rather than the PRA. That's huge. Being able to pilot now doing partial internal models from next year, which puts then Lloyd's in the same as many other jurisdictions which allow partial internal models. For the PRA to allow that, that's huge. And then we've got our annual plan now where Lloyd's and the PRA agree in advance what the major themes are for oversight. So you don't have Lloyd's doing something and the PRA doing something, and then as a recipient of that, you must be like, oh God, do they not speak to each other? Why are they asking us the same questions? So a lot of that. So that's massive. But we have to do it. When you ask about the pace of change and are we doing enough quickly enough, I think we have to do it very thoughtfully and deliberately. Similar to our own outcomes focus. And so when we regulate people, we have an outcomes focus. We need to demonstrate to the PRA that the cooperation agreement that they have with us and the deduplication work that we're aiming for is having the right outcomes. So we don't want to move. You don't want to move too quickly and put that at risk. And obviously, if we chart the sort of walk the path at the right speed and correctly with the PRA, then the chance of more deduplication, for want of a better word, is there. So I think there's probably more that we could do with the FCA. We've definitely had more success thus far with the PRA, but that's where most of our managing agents experience the greatest duplication. So yeah, look, I think it's great steps forward. We spend a lot of time here making sure that our relationship with the PRA and other regulators is as strong as it can be to enable this sort of cooperation to take place.
Yeah, and I suppose the other thing, while you're going through that sort of deduplication, you want whatever emerges from that to be completely sustainable and not having to reverse it from there. So putting the effort in and don't run in too quick makes it, then you cement it in as a go forward future proofing, as opposed to saying, oh, we forgot about that because we've gone too quick and have to unravel it and start again. Yeah, I can see that. I suppose in summary, we all need to be as patient as we possibly can in terms of that movement. So that makes sense.
Yeah.
Okay, we couldn't have had this discussion without referencing digital transformation and Blueprint 2. I can see you smiling. So again, and no surprise me asking you sort of your confidence in project delivery, and probably for my members and over sort of 130 of our 260 plus MGAs are Lloyd's cover holders. So, we have certainly a significant skin in the game here. When is it likely that, cover holder businesses will be brought into focus?
Okay, so I guess starting off, we're committed to supporting the replatforming of the markets for resilient and cloud-based infrastructure, and that's like a priority to position the market to the future. We've also shared in September that we're committed to keeping the heritage systems operationally resilient until at least 2030. So there's assurance about long-term stability in this intervening period. So that's sort of the first piece. From a cover holder's perspective, we've established, as part of a restructure of my team earlier on this year, delegated strategic change pillar, which will be responsible for driving the transformation then within the delegated space that we need. We've done quite a bit on a future state architecture. So what should that target state system, what does the data architecture need to look like? It'll address the questions that we have around Atlas and DCOM and their long-term viability, which I know is...
I get asked that every other week, actually.
And a key principle around some of this is openness, right? So we need to enable ingestion of data from external sources rather than maintaining our own systems. But we know that neither us nor the market are there yet. So again, similar to we can't run before we can walk. So we need to do this properly. It may take some time. We are also, I think, as I said earlier, the tactical improvements we can make. Can we remove 30% of fields in decom just to make it operationally efficient whilst we do some of the worst work? Absolutely. The streamlined compliance, looking at computable contracts, etc., with the LMA. All of that piece of work is ongoing. So, there's sort of the operational resilience piece, which is market wide, and then we're really spending a lot of time, as I said, on the delegated going of the systems that we have. I once had somebody draw up for me on a whiteboard in my office. I went, how do all of these delegated systems work? I was like, God, it looks like a spider has accidentally walked across the page. I mean, it's a really complex sort of web. And I was like, okay, how do we unpick this so that there's straight lines going through to systems that, rather than this random, sort of higgledy-piggledy everywhere? That is not a small undertaking, but it's something that we know has to happen in order to support the market. Our job at Lloyd's is to support the market, or to provide the infrastructure and the platforms that the market can write the business that it wants to write. We shouldn't be in the way. And I think at the moment, Atlas and Decom are probably slightly in the way. And so how do we get to a point where they're supporting the aims rather than creating unnecessary burden? And that's a lot of the focus of that strategic change team.
Yeah, and I suppose for our listeners, what we'll ensure as the association is that we'll align with your sort of DA sort of pillar, so that that you can get that feedback from members, because hopefully that spider across the page will sort of be erased at some point. It will be a nice easy drawing at some point in terms of how DA works within Lloyd. So we'll take that forward sort of separately.
Yeah, no, sorry, we really do appreciate the feedback. Like, the worst thing that Lloyd's can do is design something in isolation without asking the people that actually use it. So, that's 10, 15 years ago, that was probably the case. Here it's, new leadership team is very much we know exactly who our customers are, and we need to therefore make sure that what we are doing is in service of our customers.
Okay, excellent. Okay, we'll take that on behalf of our members, and we'll make sure your team get that necessary feedback. So that's excellent. Okay, so finally, if we hopefully have this conversation in 12 months' time, close to Christmas 2026, what achievements would you have liked to sort of be sharing with me sort of in 12 months? Hopefully the first one will be that the shallowest of the market is now bottomed out. That will be number one. But what else would you sort of aspirations for 2026?
Yeah, I think what I'd like to say is that in 2026, I'd like people to look back and go, we've judged Lloyd's by what they've done rather than what they've said. And so by that, I mean, what's been delivered. So, the business plan, I've said that the combined ratio for 2026 business plan is 91.2%, assuming normal cats. I would like to be here this time next year going in a normally normalizing for cats. That's what's been delivered, because his performance is so key. So our ION performance has been so strong. I'd like to be able to sit there and say, yeah, I don't think we will have, we won't have revamped Atlas and Decom, but I think we would be able, I'd like to be here and say, we at least know what needs to be done. And we have we've worked that out, and we've had enough customer feedback to say this would work and this wouldn't. And we have a roadmap for how that might happen. And I'd also like, given our comments on claims earlier on, that there's some tangible progress made on claims inflation. And I think, as you say, changing the language in claims just generally in the market to it being a strategic lever of your organization, rather than sort of the necessary evil that sort of picks up the problems.
Yeah, no, okay, absolutely fantastic. Rachel, I can't thank you enough. Thanks for taking the time to talk to me and talk to our listeners. Really fantastic insight into all the things in terms of what you do and your team. It's for me to wish you have a fantastic festive break, and look forward to catching up with you in 2026. Thanks very much indeed. All the best.
Thanks so much. Thank you.
Many thanks for listening. We welcome all feedback, so please get in touch with your suggestions on topics and future guests. Please don't forget to subscribe on your chosen platform so that you don't miss out.